Welcome, everybody, to our May 15th episode of the Build Weekly Roundup. We're going through three topics today around Not Your Father's Recession. I think Matt has done a really good job of kind of identifying some key themes here that relate to why this upcoming recession might not look like previous recessions, and also why we might not even have a recession. So I'm really excited for you all to hear today's episode. First off, though, the Geneva truce. A lot of interesting talk between China and the US, able to make some trade deals happen out of Geneva. On the credit expansion piece, we'll go into detail on how the tariffs are actually potentially reshoring US dollars. And then finally, how might the SLR exemption actually help us to ensure we avoid that upcoming recession like we were talking about? So before we get into it, I want to hand it over to Dave here so he can actually give a little bit of context to what Matt is going to talk about throughout today's episode.
Yep. So I'm not a huge believer in coincidences. And last week, Scott Bessent, the Treasury Secretary, went on Fox News and was talking about how, well, he was just going to happen to be in Switzerland negotiating with the Swiss, and our so-called, rival or opponent in this trade war, so to speak, the team from China was also going to be in Switzerland, and so they just decided they'd get together and have a conversation. So uh, even in the same breath, talked about, look, this isn't sustainable, especially on the Chinese side. But Besson has said this is the equivalent to just an embargo, a trade embargo. And Matt, you're going to get into this, I know, but what's an embargo? Well, literally, ships not arriving, ports empty, you know, uh, trade shutting down. Um, so this is not what they want. They don't want to decouple. So no coincidence what happened, or no, it was not random what happened in Switzerland that they both sides came to the table and said, okay, we're going to pull back. Um, Related, Walmart just released earnings today, and they're now they're talking about the impacts that the US consumer is going to see if the US and China continue on this path, which is effectively a trade embargo between the two nations. So they Walmart, obviously being a massive retailer, is better positioned than probably anyone to figure out how to smooth out these effects. But the fact of the matter is, the Christmas shopping season is being prepared for right now by retailers. They're going to have to place their orders. They're going to have to take deliveries. So both sides need to come to the table. And Walmart is saying right now their forward guidance and their operating assumptions of continuing to do well are basically assuming that there are policy discussions, there are bilateral agreements in principle, and there's existing good faith discussions at the very minimum. So, with that context, let's jump into Matt, and we can talk a little bit about exports, imports. Um, I know there's some news on Boeing, so Matt, I'll kick it over to you.
But to open the discussion, the Geneva Truce, what are the key points? China gets its exports turned back on for a temporary basis. Let's say that. 90 days is the cool off period. It begins, it technically began yesterday, May 14th. So that'll take us into August 14th, um, which is right up on the calendar schedule for when Scott Bessent gave notice that the Treasury would hit its crossover date or X date when it would need the debt ceiling extended to allow the government to tap more debt and resume the kind of multi-decade, multi-generational trend of the U.S. Fiscal debt situation screaming off up and to the right. So for now, you see this one quick data point here to see the snapshot. U.S. or China exports turn back on, U.S. importing again. You saw prices for a 40-foot shipping container, just standard TEU, ton equivalent unit, I think that acronym stands for, from Shanghai, just bounce a bit off of those April 2nd lows. Generally, in an economic downturn or start of the bottom of a credit cycle, you expect some indicators to start flashing, like exports slowing down. This is really one of those. You see the price for renting space on transit from China, Shanghai, all of its key ports, exporting their goods to the rest of the world, generally starts to fall as demand from the call them developed market economies who have traditionally held the capacity to borrow and debt finance more consumption. You see those rates start to bottom out. So that's what we saw this week. It's by no means an aggressive move up like you would see in an import surge when the economy is really humming along. Not just the U.S. economy, but the global economy. But it did bounce on that notion. So remember last week we talked about when US imports turn back on, what does that mean? The dollar gets to go out. Dollars flow from the US to the rest of the world, which means your global money centers like Hong Kong, Tokyo, Singapore, Abu Dhabi, etc. They'll see the dollars come back in as exports turn back on. Second item, moving on to the second slide in the deck. Another interesting feature, you've kind of gotten the sense that this is a global capital war at the very least. May or may not also turn into a kinetic war on certain battlefronts as they pop up, as the regional powers kind of bump up against themselves on each other's sphere of influence. But a key part of the war fronts, right, of where that conflict can take place in this era, as opposed to prior generations where this happened, World War One, World War Two, um, aerospace and space in general is one of those things. So part of this truce, interestingly, one of the details tucked in was actually that China concedes and removes its domestic ban on its own airlines taking Boeing aircraft deliveries. So Boeing, kind of as everybody knows, it's not just a maker of passenger planes like the 737s, those popular consumer aircraft models. It's also heavily involved in the satellite aerospace and other aircraft kind of
And military,
manufacturing military
everything.
complex.
Yep.
Yep. So if you followed the story of Boeing for the last, I'd say 5 years, but it could go on further of a decade. It's a complicated corporate story, but it is a key part of the U.S. industrial base. And without a aerospace defense manufacturing capability, if you're fighting in this war, that's really, if you lose that, you're fighting with like a key weapon taken away. It's like a hand behind your back. So to get that out of these concessions was key. It shows the priority of this administration. It's not just a capital war. The Department of Defense is also tied at the hip to what we see going on. We'll leave it up Boeing, but you just see the stock price here. Boeing, 2024 wasn't a great story for Boeing. Went through some credit problems, had to do some complicated issuances in the private market to recapitalize itself. Hopefully, that from the right hand side of the balance sheet, the capital side, it's kind of found a strong position. Um, did a large preferred shared offering to raise for itself. Its credits were a really cuspy performer within the investment grade space. Some of the highest yielding industrials, but with the priority and the U.S. government behind it, very clearly it's showing up as a one of the key items out of like 5 or 6 bullet points on a temporary truce. Tells Boeing is playing a very important role in this process. Now, to go on to the main front of the battle, why did we even force China to the table, right? The reason that they had to come in, I know Dave showed you that first slide. People, hey, I'm going to be in Switzerland. Oh, you're going to be there too? Oh yeah, let's get together and maybe have a tea or coffee, and we'll just chat it out. No, this wasn't that. We talked last week about the problem facing Hong Kong, the dollar squeeze that was crystal clear in the HKMA's data. You can see it in HIBOR, the Hong Kong interbank offering rate, that there was a liquidity squeeze. And that is really what brought the two parties to the table to extend out a truce. So both sides got a bit of what they wanted. China mainly gets its dollar flows back, and the U.S. Exceeded some important concessions as well for its own priorities. But the key thing here in from the capital war standpoint is if you look at the interest rates and money markets, and these differentials matter, right? You're on a global dollar standard, and if you don't have enough dollars within your own money center or your own regional, financial base, think about these in terms of blocks. You've got the U.S. obviously, which is the core. It is the domestic economy. That's where the dollar lives from the sovereign standpoint. But offshore, you've got Europe, you've got Southeast Asia, you got the Caribbean for all the wealthy, business deals that take place, that type of stuff. But in Southeast Asia, the center, the financial center, you've got a lot of them that are important, but the most important one for Chinese trade, uh, the export industry, it's through Hong Kong. That's how China interacts with uh, the dollar system. Is really, it starts in Hong Kong. You look at these interest rate differentials. I've got the 3-month HIBOR rate, and then I've got the 3-month T-bill in yellow. And you can literally see when one money center is trying to attract more dollars in, right? Why do you need more dollars? Well, everybody has a lot of dollar denominated debt outstanding, and you've just got to keep the machine humming along, right? When the debt service comes due, you have to make sure there are enough dollars within your financial system for your private sector industry and your governments to to service their debts so that they don't default on their obligations and liabilities. So if there's a squeeze for a money center, if it's able to attract dollars in, if your financial system is in a condition of health and you can raise rates to attract more dollar deposits into your, you know, regional hub, you'll do it. And this is what we saw in 2022 and 2023. The Fed said, okay, they saw inflation starting to get out of control. They were behind the 8 ball, but they started to let rates rise. This is what the bond market was telling them they needed to do. They started hiking rates aggressively. Well, you see, what does Hong Kong do to keep its dollars from walking out, right? It's like letting your horses out of the barn, right? Well, you have to, because this is, a globally open capital system on the legacy dollar standard, you have to match, right? Otherwise, all of the horses are just going to walk across the open pen and over where the conditions look more attractive with higher yields, right? And so you see this going into late 2022 when the U.S. is showing, hey, we're really aggressively letting rates go up, right, off of that zero lower bound in 2020, 2021, the post-COVID environment, and you actually see Hong Kong, they raise rates further and above the Fed or the 3-month T-bill, right? They were really trying to, out hawk the hawks and say, no, 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 we're going to keep our dollars here. Well, then what starts to happen after that, right? As the pace of rate increases starts to slow down, um, you see HIBOR actually go negative against the T-bill, or equivalently, you see a positive spread of the U.S. Treasury bills, and which are really the think about it as the domestic economy onshore short-term policy rates, where those can go. And you start to see from basically the beginning of 2023 on, the Fed and the US financial system and the Treasury are able to keep the front end in the US high, which is attracting, all else equal, dollars in from the rest of the global economy, other money centers, all of these financial institutions. And that effect is really, whereas if you're in a major growth uptrend, you're seeing US importing goods, people are feeling good, the consumer's healthy, they're going out, they're buying the things that go in shipping containers and come into Walmart. They keep doing that, but as that slows down, that rate differential, that whole time that slowdown is happening in terms of the consumer, dollars are sucking into the U.S. underlying this process. And then now it goes back to the Fed meeting of last week. 3 days before that, we saw the Monday before the Fed meeting on Wednesday last week, we saw IBOR collapse, a liquidity squeeze within Hong Kong. Essentially, it's saying they're low on dollars. They needed that. They needed the faucet turned back on, and the Fed, even in the face of this, is able to keep short-term interest rates high. So that's the effect. You're getting dollars coming into the United States. Now, on top of that, the consensus is we're going to get more rate cuts this year from the U.S. standpoint. So eventually, we're going to let off the gas. But right now, you're seeing multiple things kind of working against each other to see how this ultimately plays out. And a key effect on this is what is going to happen to price levels in the economy. We don't know. Standard economics says prices should increase due to these tariffs. We're going to have to wait and see. The initial effect is looks to be deflationary, but where the Fed's at this point is you may not necessarily know exactly what you need to do and at what time. Right now, they're biased. They do think the risk to growth is low, whereas they may have to come in and accommodate. But it may be a different type of recessionary environment. If people are calling for global panic, global growth, this U.S. recession may not look like your typical post World War II up until 2020 type of recession. And we'll get into like why that is. Rising prices, but also rising credit um,
So Matt,
expansion in the economy. Well, yeah, go ahead.
yeah, maybe I'm getting ahead of you though. So dollars coming in,
Mhm.
theoretically chasing higher yield or differentials, right? They're coming in, they want to deploy into US rates. But if there's more dollars flowing in with the same number of borrowers, let's say, doesn't that put downward pressure on rates? And I know you have some slides to talk about this, but I kind of want to tee up that discussion. Isn't that actually going to suppress rates as people bid
Mm,
up these treasuries?
Not necessarily. So you start with how are rates composed, right? If you just start with treasuries, right, you assume no credit risk. Um, Classical model is you break it down, there's real growth and then inflation expectations, so that you should essentially earn some real return for saving your capital. Now, can you do that in treasuries? That's debatable in this environment. But just because you have more dollars flowing in, that doesn't mean yields go up or down. Like it all depends, right? Um, you have to see which way how much do real returns budge, and usually those are pretty stable. And then it's those inflation expectations, right? So
Yeah.
that's how the market will ultimately clear. If your currency if you're losing purchasing power, um, over a given time frame in a bond, yields will adjust over time. Investors will react to that. If they see inflation or prices increasing, treasury bill, bond, note, et cetera, not able to hold its purchasing power, they'll sell. Versus if inflation expectations are coming in, growth coming in, et cetera, they'll buy. So you really don't know quite yet which way rates need to break.
Got it.
Okay. But the trend is for onshore deposit growth, and this is coming from the Fed's, every day your regulated banks are submitting, their balance sheet composition to the regulators once they're past a certain size. So the Fed actually has, really solid oversight. I know it doesn't seem like it sometimes, going back to March 2023, where the duration issue at Silicon Valley Bank and other smaller banks in the U.S. Um, came out of nowhere, let's say, from a regulatory standpoint. They do sometimes miss it, have their eye off the ball, but from a reporting purpose, they have really good data on what's happening as far as the balance sheets across the domestic U.S. banking system, where they actually have regulatory ability to, force compliance. Um, but what we've seen really since 2024, and this chart goes back further, is an up and to the right trend in deposits on the US banking system's balance sheet, right? So increased deposits, like some of this will be coming from the reshoring of offshore dollars, right? Um, pulling dollars out of Hong Kong, out of other money centers, and chasing at the front end that the higher yields that the U.S. can offer. But it's also coming from the increased wages, uh, say that American workers are, seeing as uh, uh, price level rises, credit expansion, all of that stuff works its way through the economy. So deposit growth trending up and to the right is a key development that needs to be watched as we keep watching how this trade dynamic plays out. But in reality, what is this people call it a tariff war? That's not the right term in reality, because if you think about it as a trade war, a tariff war, you focus on the actual goods and the shipping container, but where the
Mm.
rubber actually meets the road, what actually matters is the financial side, and the capital war. And I've said this, before, but in the standpoint, once you get to the point where, let's say, two sovereigns are not cooperating anymore, all wars are capital wars, right? Because once you run out and can't finance yourself as one side in a conflict, you're done, right? If your other side can continue to finance themselves and you can't, you've lost.
How
Um,
many how many headlines have we seen where it says Ukraine is a week away from running out of supplies, and then miraculously they have supplies and the war keeps going? I think that's kind of what you're hitting at.
Yeah, well, on that front too, you've got to have the industrial base to produce. You got to produce bullets, bombs, drones, etc. And all of this matters, right? You got to be able to produce, but production is tied to capital financing as well, right? Do you have the capital to build an industry? Can your industry be competitive? And what matters in industry is cost, right? You got to be lower cost, and then you can work that through your currency, foreign exchange markets, etc. But if you're not cost competitive, and you rely too much on your currency, as we've done for 50, 60 years, you lose that industrial base and you lose that ability to fight the war. So it really starts and ends with balance sheets, right? And your ability to fund yourself, to fund your war. But this deposit growth is a key trend. What it's actually doing is it's creating liquidity inside of the US financial system. And generally, like, in the post 2008 environment, where the center, like ground zero, was uh, credit contraction, or like a credit failure of subprime US mortgages, really. Like, we were the epicenter. It was our credit that went bad. We had to reflate it. The way to reflate it was central bank balance sheet expansion, as the US's financial issuers, or intermediaries, had to pull back because their balance sheets were impaired. Post Lehman, post Bear, all of that. This time around, we're in a different era. We're not in the 2010s anymore, and banks are probably in a position where once again they're able to fund themselves through deposits. And if you go to the next slide, pulling more dollars in offshore is actually creating deposits inside the US. And typically, if you look at deposits on the right hand side, the capital side of the balance sheet of the aggregate system, and then the left hand side where those deposits that call them savings, right? Those are transformed into new loan assets or new credit. $1 in new deposits is 70 cents, or $100 in new deposits is $70 to make it a rounder unit of new credit. And that new credit can be anything. Like, it can be, hey, we're going to buy some US Treasury debt. There's definitely going to be some of that. We're going to buy some corporate bonds. There will be some of that. We're going to issue home mortgages. We're going to issue auto loans. We're going to issue credit card receivables, all of the above. But that deposit growth, that trend up and to the right, so long as that continues, credit continues to expand in the United States. And then you look at the other inputs to the bottom, to like what you see in the easing of the short-term credit cycle, the bottom of the trough. It doesn't always have to end in something like a 2008, widespread credit event, or a 2020, I call that a like emergency credit event. Sometimes it's just a bottoming out, and so long as the engines are still working on credit expansion, the system, as things slow down, can touch and go and just shoot right through it. And this is kind of what you hear the talking heads communicate as like hard landing, soft landing, no landing. Well, what does it actually mean? Is the credit engine stalling out, or is it actually just maybe downshifting a few gears and then shifting back up? I'd argue so far everything we've seen um, suggests in the US it's more of the you know no hard landing. I don't even know that a soft landing, even though these are undefined terms. But what would a soft landing mean? Obviously we can agree a hard landing is 2008, or they call 2008 the hard landing, when there's
Sure.
unemployment up at 10%, interest rates have to go to zero, like a lot. It just feels bad. There's no economic activity. You can't get a loan, housing prices down, all of the above. Your friends and family are at risk of losing jobs. That's the hard landing. Soft landing, I don't know what that means from any technical definition. But the no landing situation is where, maybe you do have negative real growth. And by that, I mean, hey, prices go up of an individual good, and you can afford fewer of those goods and services than maybe you used to, if you could like fully extend your consumption to the point of saturation. Um, but you're still going to have a job, and your, nominal income will just keep humming along. You won't
This
default
this
on your
sounds like you're
mortgage.
this sounds
Yeah.
like more like a standard of living flattens out, or maybe you have to cut back type of situation versus a I don't have a job.
Yeah. Yeah. So so long as we see those trends continue, if the US can actually hold rates higher, and it may not be, as Dave, you were talking about, the cuts, forthcoming, that still, even after the bond market has sold off um, month to date in May, and extending out rate cuts further, or potentially never, um, you can still see short-term interest rates come in, which is really impacting the money markets, um, without kind of breaking that longer-term inflationary backdrop. Those two things are compatible with each other. So to get this, like to isolate on that fact that, hey, credit expansion does look like it's humming along. I've got some slides here on what's going on in the investment grade US dollar corporate debt market, right? And so within corporate debt or within investment grade debt, you've got three groups, three buckets. You've got sovereign debt, treasuries, right? You've got corporate bonds, which is the private sector businesses. And then you've got a third, which is mostly mortgage-backed securities, but it's other packaged up securitized debt. You can throw some auto loans in there, credit card receivables, but it's basically consumer debt. So you got those three tranches: governments, private businesses, consumers. So the focus here, you start with the um, the corporates, right? Why? Well, we know the sovereign, right? The sovereign is going to get funded whatever it needs. It has to, otherwise this whole thing, the whole machine just falls off the rails. So the important thing to look at, don't waste your time necessarily isolating the fiscal situation of the treasury, because we already know that one's a pretty easy picture to wrap your head around. We had some slides in on kind of the abandonment of Doge, the Elon Musk kind of efficiency cost cutting effort. My takeaway, and Dave and Cameron, you can chime in here, but what I would see that as was the first or kind of the only approach that will be taken as seeing if we could solve our way out of the debt problem through getting rid of waste and efficiency. And I think after 3 to 4 months, the verdict is out. That path, that fork in the road, or that option to go down, it doesn't exist. It's not a real solution, for probably two reasons. Number one, there wasn't enough fat, like fraud, waste, and abuse, to cut and make this debt problem resolve itself through that alone. The actual Doge savings were, paltry and compared, like they don't even add up to 1% of this year's deficit. So
No,
you,
right now they're tallying what we thought several weeks ago was where they're at, maybe 100 billion to 150, 160 billion, which
like half of that is what
it,
I've heard. Like,
yeah, a lot of it was the paper receipts that I was showing, that they were saying these were things that were POs that were never really executed upon. So
yep.
in my
And
mind, it was a little bit of theater, but
and then after that, besides the fact that, hey, it turns out most of the spending is actually congressionally authorized. So you're gonna have to, the only way through this is to one, there's probably two options. One is, run it hot and inflate it away, which is the path we're going to go down, as I'll describe. Or two would be some sort of congressional spending reform that could still get through, but that looks doubtful as well. Um, but for Doge, I think the other element that for why that was rejected, first one being there just wasn't enough just fat to trim, is the widespread rejection of the cutting efforts. So my wife works in the medical and healthcare industry, and most people, I think, in the economy, like if you're not a financial professional, you don't understand the credit situation and the dynamics we're facing from a fiscal standpoint, or that the dollar is facing. These are insanely hard things or complicated things to wrap your head around. And you've got a day job, right? You're taking care of patients. But when you see something, and I'm just isolating one specific group where a cut impacts them and they raise their hands and reject it, but there's several of these across the board. But in terms of medical research, healthcare funding, grant cuts impacting the NIH, the reaction from healthcare workers and that contingency of society was just a massive, like, no, what are you doing? We need that. Well, it turns out when you're broke, you can't afford all these things, but it's insanely hard to convince someone who's gotten used to having that funding and never having to think about it. Try telling someone you're broke and pulling something back that they already have. Charlie Munger called this the deprival super reaction principle, right? You give a dog, like, the worst, the easiest way to make what's been like the best dog in the world, like tap into its vicious, wolf roots, is pull meat from its mouth and just watch it bite your hand. Um, that's the deprival super reaction principle. When you take away something that someone has, come to, um, get used to, they will reject it. I think broadly that's what we discovered was there, and the Doge cuts showed that that's not an option to get the U.S. Federal government's fiscal situation out of this. And it also means, in my opinion, the outlook for cuts from a congressional spending austerity type of situation, that is going to be extremely difficult to accomplish, fiscal solvency or getting us back on a better track from that standpoint as well. So I think the only option left is to run it hot, right? So on the tail end of that growth of U.S. dollar deposits hitting the banking system, what do? Well, juice it. You increase credit expansion, right? And because of the post 2010, all of the QE you did in 2010s, reflating your too big to fail banks balance sheets, and now we can talk about the third bullet point will be the SLR relief coming. You can stuff them with some treasuries as well, zero risk weighting. You can use that as collateral to fund more loans, rinse, repeat. Um, but you're if you continue to see credit creation, um, not just hold up, but potentially even accelerate, which is what we're starting to see, you will see nominal growth run hot. Maybe real growth is that itself will pull real growth up, may possibly keep it above zero, which would be a recessionary environment in real terms. But those two things, like you're pulling up that inflation expectations component of interest rates, which is going to ultimately materialize in rising price levels in the economy. Um, so
So Matt,
this
can I
is
jump
yeah.
in with,
Go ahead.
I mean, with that question of like, we're just going to run it hot, sweat it out. So wait, the narrative I'm hearing is that we need to roll over something on the order of $9 trillion worth of treasury debt in the next 12
Mhm,
months, right?
mhm, mhm.
Besant has been clear that he's focused on the 10-year rate, getting that down. He said something like 1 basis point on the 10-year rate equals $1 billion roughly of interest payments. So everything that I'm hearing is that they want to get that rate down. How can they run it hot and not just balloon the debt? Or are you just saying it can't?
So you've got to hope. Okay. Yeah, it is an unknown if we can actually stop the exponential increase in the debt. The I honestly don't know that it's a given that we can even get interest rates down, and we'll get into that um, on the final slide.
So we could be in a pickle.
Oh, we're totally in a pickle. That's beyond.
Do I get the Captain Morgan, Captain Obvious badge?
Yeah, exactly. It's not easy, and these are the things where there's going to be trade-offs. Um, Something's got to give. I have, gone on record as saying like I don't think you're going to go back to a world of lower interest rates. The question is, can you get the treasury, the fiscal situation? Can you actually get nominal growth in the private sector up at a level that would allow your tax revenues, to tailwind off of that, and then grow your tax revenues at a rate that exceeds the growth in interest payments? It's a really hard needle to thread.
Well, and I
I,
think that
I
raises the
honestly don't
question for
know if it's
me of,
accomplishable.
yeah, I mean, if you're saying you've got to find a way to raise tax receipts over time, it sounds like you need to create actual productive growth, right? So then the question becomes, where are we actually loaning this money out, right? If we're creating new credit and it just all goes to all of our OnlyFans
Yeah,
subscriptions, that's not exactly going to be ideal for the inflation over time then.
no, and no subjective judgments here, but yeah, there's a difference in where productive economic investment goes. Like if you use your credit capital to, finance a vacation that you otherwise couldn't afford, well, terrible use. And there's a laundry list of malinvestment, unproductive uses of credit that we could say have taken place in the post 2008 environment. I think the key now is that credit expansion has to be directed like towards economically viable investment, right? If we screw it up again and just follow the mindset that I think permeated kind of policy from, especially the last 50 years, George W. Bush after 9/11, hey, go, just what can you do to help? Go out and go shopping. No, that's not going to work anymore. If we just go shopping and run up the tab for the sake of just, yeah, get rid of your closet and replace it with something new that makes you feel better, but you'll be back in the same boat in a year with more more debt on your household's balance sheet. That's just running faster at what is ultimately going to be a big hard brick wall. So where this credit goes, like that is the key. It has to go to productive projects, and that's where, in my opinion, you're seeing this administration focus very specifically on, say, for like on deals, right? If you go and look at where they want to see the growth going, right? SoftBank deal, the Oracle deal from a while ago, the handshakes across the Middle East this week, semiconductor production, AI, electronics, aerospace and defense. Like it's got to make its way to the right places, because if this is just going to NFTs and JPEGs, the whole thing is in a bad way once we take these numbers up to the next order of magnitude, and we're even further behind in terms of the economy's ability to service the debt burden. All right, so let's get into these slides that we've had up for a while. The investment grade primary corporate debt issuance market. So this is every week, every day you fire up your Bloomberg terminal and you see all the investment bankers, send us the Bloomberg ad saying, "Hey, I've got this deal here. L'Oreal wants to raise." Like all of these have just been picking up steam since about the middle of April, I would say. Um, and so if you pace year over year, 2025 is in blue, and then the white box around that is the 2024 column, cumulative credit issuance and corporate debt for each given week. And you can kind of see the pacing. Like 2025 has been a slower year than 2024. And this is just part of the overall credit cycle, right? We're having to cut because the capacity to borrow is decreasing because economic activity is, gradually slowing down. You can see this in the GDP numbers. But it especially, halted. We have not yet gotten back to, 100% pacing on the 2025 number to 2024, but we slowed down the most in the last half of February. But then really we bottomed out that middle week of April, like that first week post tariffs. But since then, we stepped back on the gas ever since we got rid of what was it, like the week after Liberation Day, where we called it round one. Things settled in, capital markets, unfroze themselves, and issuance has been moving up and to the right. So as of this week, we're above 96%, almost 97% on pacing to prior year. And if these trends continue, right, if this underlying backdrop that I've talked about, deposit dollars sucking in from the rest of the world into the US, loan growth taking place off of that. Even further from that, foreign corporations. So I mentioned L'Oreal specifically. Why? This week, they launched their first dollar bond offering from the US based financial market. So the first, call it an onshore dollar bond, where L'Oreal tapped its dollars, not out of London, not out of Paris, but right here in the US. That's a key signpost. A major European conglomerate, to get the dollars it needs, has to come to the US, right? You can't create these synthetic offshore dollars any longer that you could in the rest of the post World War II history. Um, so if you go down from there, you just drill down one level. I'm gonna split that IG issuance between financials and non-financials. So why financials are important? They're really an intermediary. They go out and raise dollar capital through like a bond offering on their balance sheet. On top of, if you're a bank, you can utilize deposits to fund them. But you see like private credit issuers as well, annuity issuers, like they're all tapping to go out and create new loan assets to fund, get dollars flowing into the rest of the economy. So financials are your key intermediary. If they're not expanding, they can't go, recycle that debt and create a new loan for an industrial issuer or a utility to go out and create an actual good or provide a service into the economy. Right. And so what we saw year to date, the financials rushed in January, front running. They wanted to go out, tap debt markets quickly. They were actually well above 2024's pacing. So the financials stockpiled themselves early. They went out and built out a treasure hoard of dollars on their balance sheets. And then from that, what do they look to do? Well, with that, they can't just sit on dollars or park it in treasuries, right? They'll have negative spread. They won't make any money. They have to go out and lend into the real economy. And so as we headed into Liberation Day, right, we started slowing down. And then for 3 weeks there, the last week of March, or yeah, the final week of Q1, first week, the week of Liberation Day, April 2nd. And then the week following, you see that red arrow, the financials stopped expanding, right? They slowed down. And then they also, on the next slide, we'll see they pulled back on credit creation, extending new credit to borrowers to go out and do something. And this was just over paralyzing fear, right, of these tariffs, right? But as the market has set in and gotten its footing, you've seen the financials begin raising debt again up and to the right. So they're part of this borrower base that is pushing us up to um, that, like up against that 2024 pacing, pushing the credit expansion back up to where we were in 2024. And if you see this trend continue, you won't see a recession, like from a nominal standpoint. And this is really like the goal, the key objective. You cannot have a nominal credit expansion slowdown, right? If the musical chairs stop, if the music stops, and you have to mark to market bad credits, that's a situation that can get really ugly. So you don't, from the credit system's perspective, it wants to keep the party going. It wants to keep the dance going. And eventually, we're going to have to pay the piper, right? We're going to have a bad hangover, but you don't want it to be through like a credit contraction from the standpoint of this legacy system itself. So you've seen financial issuance, we're back up after stepping on the gas starting mid-April. We're back up to pacing above 2024. We've been ahead for every week in May. And this is just a drop. It's like every day, 7 deals, 8 deals, new investment grade issuance, and the market is open. So this is
Matt,
not
what's the
consistent
what
with like
what what term are these issuers on average borrowing on?
yeah, most of it is fives, tens, little bit of long end 30s, but I'd say most of it is like belly type fives and then a little bit of tens. Very little of 2 year, 3 year, like short term borrowing. The lower quality the borrower, they'll have to choke down and do a 2 year or 3 year, like shortest term type of debt offering that you would see.
Got it.
So now for the non-financials, these these are like the real economy, right? Producers, service providers, etc., who have to go to their financial institution for money. Um, and so they're dependent on whether or not their banker, their lender, will make credit available. Um, and so for the beginning of the year, we had some pretty weak growth out of the gate. They were well below their numbers up until, I'm following the orange dots now, starting about January 17th. Up until the end of February, they were pacing at between 70 to 75% of their year over year run rates. So this was saying the banks, financial institutions, they were pulling back on extending credits because they didn't, it's kind of a sign that they didn't know what was in front of them. They didn't have an idea what was in store. Starting about March, uh, they accelerated. We started to catch up to where we were in 2024. But then we got that flatlining again, and essentially like credit creation in the corporate debt market down to a trickle from beginning of April to mid-April. But since then, it's picked up again. You see in the green arrows, it's moving up and to the right. So these guys, the industrials, they eat second. Like the financials had to go out and raise capital on their balance sheet first. So the financials are, filling themselves up. By definition, they have to go out and lend that into the real economy eventually. I mean, they can pay off their own debts, make sure they are able to meet their own obligations, which are all going to be, financial liabilities. You got to pay off their own bonds, make sure they settle their swaps, all of that. But then once they, after that, then they can start feeding the real economy. And you're only just now, in May, starting to see that number go up and to the right. So this reaction you've seen in equity markets, you know, 9 days in a row up. You only see that if the flows are positive and like you've got a constant stream like hitting you like it's at that level from the broker dealer standpoint who are making markets and financial assets. The reason you see stocks or risk assets start moving up and to the right is because their posted offers are getting lifted, right? There's an inflow of cash that's coming in, that's working its way through the real economy. The ultimate beneficiary then who provided that good gets the cash that was someone else's credit. They go out and they need to save it somewhere. What do? You choose your preferred savings vehicle. Some of us want more stocks, some of us want more Bitcoin. Rinse repeat. So what's happening is the dealers, they set the bid ask, and well, there's an inflow of cash here from all this credit creation. It's working its way through the from the financial economy into the real economy. And then one by one, day by day, those offers get lifted. And that's why you see risk asset prices, starting to trend up and to the right. So if this continues from an asset price standpoint, nominal standpoint in terms of economic growth, this is not, at an absolute level, like the nominal perspective, recessionary. So long as you keep the credit expanding, you keep the water flowing through the system, um, you don't have that, typical like your father's recession type of environment where you see job cut, like extensive job cuts, bankruptcies, unemployment, deflation, etc. This is the mirror image of that. This may be your version is the real recession, right? Where maybe it's things get harder to maintain your standard of living because you're just chasing after, more credit creation, chasing the same or scarce assets, stores of value, or even the consumption goods and services like going out to a restaurant, going up into the right, like labor costs. All of those things are increasing on the system dynamic. So you're struggling to maintain or even grow your actual standard of living. But from an nominal standpoint, your balance sheet should be doing fine, right? You won't be contracting. And if you pick the right assets, for your allocation, you can actually still get growth above these hurdle rates. So that's really what's going on the credit front. But what we're watching, everybody who is Chicken Little after the tariff, sky is falling. Where are all the shipping containers in the port of Seattle? This is going to be the worst thing. This is 2008 or 2020 all over again. No, that's not my base case or house view for how this materializes, and it starts with understanding the system dynamics. So maybe pause there, ask a few questions,
So,
and now
so
we
Matt,
got to talk into what the treasuries are doing in response
yeah.
to this.
So no, you talking about the reaction for just the everyday investor. I think a lot of the times when I don't know exactly what to do, I ask what is the outcome I don't want, and what is it that I'm sure I don't want to do, and that helps. So, what's your input for investors right now in terms of what not to do?
A lot of things. You can extend that to like life advice, period.
Well, let's
Don't
hone it
don't
into
be the
what we
last.
do.
This is going to be a high volatility environment, right? And the backstops that you counted on over the last 50 years, which every investor alive today has gotten used to, um, was like the Fed put or the Treasury put, right? A bailout of all of the GSIBs or a bailout of Silicon Valley Bank. Right now, if we were forced to take a nominal recession, we do not have the capacity to exercise that put from like the system standpoint, from the backstop, uh, in the same way that we did, over the rest of our lifetime. This is my opinion, right? Because we're already running, 6, 7% deficits in non-recessionary time, right? What happens when you have a nominal recession, a 2008, a 2001, et cetera? Well, deficits go up, right? As economic growth slows. So if we have to go into that again, um, it's just going to make this problem that's already exposing itself. It's going to take like your cancer from stage 1 to like the next stage in the progression, and your problem gets worse and worse. Um,
And
so I certainly don't want to
does the
see
Fed, do we have any ammo to even fight that?
arguably no. Yeah, right now, or um, tacitly recognizing um, that we do not have the capacity right now or the tolerance to QE our way out of this, nor is that the necessary prescription uh, in this specific situation. But yeah, the same approach that was tried, and can't say that it worked, right? Because it didn't avoid anything. We're in a worse place now, but it worked in the sense that it kicked the can down the road. Will that same thing work right now? I don't believe um, it would deliver the same results with that prescription. So my point is, what should you do? Well, number one, don't just assume you have this safety net, um, that the large players can save you from their problem. Because right now, the situation is you've got a Fed that needs to let its own balance sheet heal. You've got a Treasury which needs to improve its fiscal situation yesterday. So your answer here, like through process of elimination, this is the solution that works, right? Credit expansion, right? Which means brace yourself on the risk of the right tail of inflation creeping back up. And so whatever that means, I would say that's the environment you do have to take into that into account, um, and just proceed from there. Now the other element is, you do not want to see yourself be late to any trades, because in a volatile environment, if you're the last one in, like if you're The classic saying is, once your cab driver starts telling you about an investment, that means it's time. Like it's ready for, or, like you're ready for a cyclical top, right? As that late stage money starts to come in. So think about that yourself. If you're late to, say, stocks, and I know we're not at all-time highs yet, if and when we do start hitting all-time highs, but we're coming off of a very sharp rally in equity prices, for example. So this same behavior of just coming in late to something because you missed the last direction, well, the market situation and this specific backdrop is, in my opinion, very amenable or associated with like sharp reversals.
Yep.
And it could be that maybe the asset class you're choosing isn't in a strong upward trend, right? So you want to be investing your assets in those long, but say it looks like it is in the short time, like the short term, like a very accelerated run, the overall trend is flat. Well, you're going to get caught right at the reversal, and you put yourself in a worse position. So my advice is, this is not a podcast for investment advice, but it really is to study, form a conviction around where you want to store your assets, where you think you can um, park your savings to enable or achieve even just a capital preservation, where your time spent that take your savings and park them somewhere will be able to get you, at the bare minimum, the same amount of purchasing power a few years from now, right? If you do that, call it a success. But what won't work is if you're just chasing and trying to trade these volatile swings, because most people can't do it. If you could, um, you're probably not listening to us right now, because you're already a black belt at this stuff. But that's the one piece of advice I'd say I would have is study hard, form a deep conviction, and then build up a position and things you can actually have confidence that will in assets that you have confidence will hold your savings and purchasing power into the future when you really need them, right?
Yeah. Well, let's move on to the final topic, Matt. Cameron, you want to advance the slide to we want to talk about the long bond here. So, Matt, we're just over an hour here, so I know we want to be efficient with our time, but I hear the phrase, yeah, they're going to lose the long end of the yield curve. You've heard that phrase. We're going to talk about the long bond bouncing off this channel that it's been in on the bottom of the channel. What does that mean? What are the implications? Again, tying that back into how, are we going to run hot for a while? Is this going to be a long-term, is going to be an extended period of inflationary forces? So
Yep.
let's take it there.
So let's start out. So you see the treasury yield curve, right? And you see this, people talk about inversions when that's happening. They talk about the slope, talk about the level. Um, all those points on the yield curve, um, they're not necessarily all created equal, right? And you can generally chop it up to the front end, 0 to 2 years are definitely front end. Maybe you go out to 3. You get into the belly, which is your 3, your 5, your 7. And then your 10 is your area between the belly and the long end, right? Now, the long end is where the treasury goes out for its longest term borrowing, right? And that's where you can raise money. Like your highest quality borrowers, like Berkshire Hathaway, as an example, or Warren Buffett, right, who just recently retired. Like what he has stated, if you read his shareholder letters, is you never want to be as a borrower, at the whims of short-term interest rates. Why is that? Well, the stronger you are from a balance sheet capacity, you want to term that out longer, and then you also, because of that, you have the time um, to issue your debt at specific points where say rates are lower, conditions are most favorable to you, right? It's because you can issue debt because you want to when it's beneficial to you, not because you have to, right? Say at the other end of that, we talked about, a 2-year or a 3-year borrower. They're out here raising debt right now to finance themselves. They're only going to be able to do it for 2 years or 3 years, right? Then they're going to be right back behind the 8 ball, say if interest rates, say are higher from here, right? And I think we're in a secularly rising interest rate environment where we're going to see higher highs and higher lows for the going future is kind of how I operate. So if you're that riskier borrower, you don't have the stability of cash flows, or you don't have the balance sheet capacity to raise money on terms that are best for you, right? Where you can have that option to refinance or term your debt out. Um, you're kind of at the whims, right? So in terms of the US government, if you think about this, for the long bond, right, we issue a lot of different bond offerings, right? Every month we do a 2-year, a 3-year, 5-year, a 7-year, a 10-year, a 20-year, and a 30-year. But how much we raise in each one of those is a different story, right? At the long end, the 30-year, there's actually very little. Like it's like $18 billion on a monthly, new issue auction, and then maybe like 2 months of 15 billion. So what you end up with is to run these massive like $1 trillion of deficits, maybe every quarter, 50 billion of it, let's say, is coming from a 30-year, right? And that's after you pay off the old 30-year investors. So your actual new money raised on the 30-year, like call it half of that. You can't finance what we're doing. Like the actual credit card bill we're running up, the Treasury doesn't have the ability at this point. We're nowhere near being able to issue it at what you see as the rates here. This is an off the run. It's at like above 5% where I snapshot this. But the on the run 30-year treasury, probably about 4.94, 4.95% as of today's close. If we wanted to run the tab up on the long end in entirety, like it'd blow out, right? So what you're seeing in the treasury market, right? It's responding. Investors are responding to all of these things we've kind of talked about, this elephant in the room that we're trying to help, our viewers, our audience, you all who are hopefully watching, feel this situation out. They see the credit market, like the expanding issuance picking up. They see, that is monetary inflation, right? That is the definition of inflationary. Um, and so your treasuries have to react to that, right? If you see that, hey, I have a 1 to 2% real growth target, and then after that, I need to charge on the bond yield for the inflation expectations. So I, hopefully don't lose purchasing power investing in treasury debt. Well, sorry, you're probably going to. Um, is the sad situation. But what happens there is, well, rates have to go up, right? And so what we're seeing, this story, right? Remember, I talk about the channels, right? And you see the bottom we hit in October of last year as interest rates sold off after the Fed started cutting at the September 15th meeting. And then we saw another bottom in the post-Liberation Day sell-off. We're right back at the bottom. We actually hit it again, like on an intraday or like an overnight basis, or in early May. But that was during kind of a bounce and an uptrend. We're actually selling off onto that blue line again, and this is where, from a fighter's perspective or a boxer's perspective, you're on the ropes, like for the fourth time in a year at this point. And when you lose a channel like this from a technical standpoint, if you lose it, that's a signal to everybody watching the market that price needs to shift. And the risk is these bonds get sold, long end interest rates actually have to go up to compensate for, the fact of the matter is the position that you're in fiscally, you're going to have to run inflation hot as, you've gone through the checklist, you've tried all of these things, the Doge effort, hiking rates at the front end, up to, over 5% from a Fed funds perspective. Um, we can go over all these things that the U.S. Policymakers have tried. Well, turns out now we're just gonna, we can't take a nominal recession, so this is the path we have to go down. Well, the fact of the matter is, if that's true, well, you're gonna have to see a sell-off in Treasury debt. So we're right back on that bottom rail. We could bounce from here. Um, but if this continues, this is a wait and see. Watch extremely closely. If we lose the long end of the yield curve, that means long rates go up, and we're in an environment. Rates up means dollars up, but also talked about this before too. Kind of counterintuitively, risk assets have been rallying as well since roughly 2023. Dollar up, rates up, risk assets. When I say risk assets, SPY, the Qs, and Bitcoin to a very strong extent. So that's a thing to continue to watch. But if the long-term interest rates fail here and start rising, um, that's a huge risk for this funding situation. And what Scott Bissent said earlier, I want to watch the 10-year and see that rate go down. Now, the ammo that we have, the next card we have to unleash, and we know this is coming, is the SLR relief. So the SLR, this is coming out of the post 2008 international banking and capital reforms. The SLR is an extra capital surcharge that countries are asked to levy against their GSIBs, right? So it's like, all right, of all the banks in your country, you have to pick the top that you deem a globally systemically important bank, and you have to make sure that they are safer than safe, right? Because if those too big to fail, well, by definition, if they fail, then the thing that's too big will also fail, which is uh, your your financial system, which is funding the sovereign. So these kind of packs, this accord, the Basel III, they layer on this extra SLR. I want to say it's a 1.5% extra capital charge, which is balance sheet capacity that has to sit in reserves, that's not allowed to go into credit. What the SLR exemption would do would free up balance sheet capacity from the largest banks in the US, like the domestic financial system, and allow them to buy more treasuries. So that's your break glass if you're the Fed, the Treasury, etc., and you're watching this closely. If we have to pull that card, we will, and that should create a new buyer for Treasury debt across the board, but that should bring uh, rates in. I don't think it's a long-term solution. I think the private sector, uh, households and businesses are the ones who actually matter here in this environment. Ultimately, you're going to have to get them to buy the sovereign debt. And so with that kind of background in mind, I think this SLR exemption would be a temporary measure, but it could get us off of this pinch we're in. I mean, we already described the fiscal situation as quite a pickle, but being at the bottom of your trend, if you're watching your asset, you're susceptible here and you want to get off the ropes as soon as possible, get saved by the bell and make it to the next round. So that's what I'd be watching for in Treasury debt.
Great, thanks, Matt, for that. I think that rounds out kind of our topics here today. Any last thoughts from either Matt or Dave?
Dave, I'll let you go first.
No, I think I don't think I have anything. I just think we really should be watching this middle part of the yield curve. It seems like there's demand there because you just talked about it, Matt, that there's the belly of the curve is where the corporate debt issuance is occurring, but that's where you have a little trough in rates. So there's issuance, it seems like, and there's demand, it seems like. So maybe in a future episode, we go deeper on that aspect of what moves we'd expect to see happen there. That's a part of it with this SLR relief that I find the most interesting. If banks are allowed to plow more in to that, so that's the thing I'd be curious to keep an eye on, is that middle part of the curve, the belly.
Cool. All right. So the Bitcoin conference is coming up. Starts the week after Memorial Day. So we'll be there. If any of y'all are going to be down there, hit us up. We'd love to say hi and meet you out there. And then also, I just recorded a Spaces on X earlier this morning with the Bitcoin Magazine team and some other financial professionals to kind of get the excitement going and marketing around the conference itself. So that's right around the corner. We'll see you there. And if you want to tune in to a little chat with a team, I think we hit on some good topics there this morning. Please check that out. You'll see it on my X profile, Leverage USTs. We just scrolled down. My retweet of the spaces should show up. So if you like what we talked about here, more commentary is available on that live stream.
And I'll make sure I include those links in the description on this video as well. Thanks everybody for tuning in to this week of the Bills Weekly Roundup.
Awesome. Thanks, Cameron.